and gentlemen, in class number 3, we look at the document number 4 in details of the pre-release information for the 2024 year. So now we are going to be looking at my slides. So in my slides, I'll be taking you through in terms of what the candidates was expected during the pre-release period to prep themselves when it comes to question of this nature. So we'll go in detail in the slides, and then you'll be able to identify the trigger and how do you go about working on the trigger going forward as you prepare yourself for your SAICA last board exam. Now, this is obviously document number 4, which was about the acquisition. I've already explained to you why it was about acquisition. Now we're going to go in details in terms of the standard that you needed to look at, as well as all the other important juices. Number 1, this is accounting for acquisition of Cafe Rapid. We've covered that this is about the acquisition. So since this was about the acquisition, or it was the acquisition paper, one of the most important standard that you should have made sure that you understand before you go through this paper, it was your IFRS 3 as well as your IFRS 10. IFRS 3 to understand how to account for the acquisition of those shares, and then as well as IFRS 10 in terms of how to consolidate for this acquisition, since we acquired more than 51% or just above 50%. So why is this a trigger? So now the question is, why am I saying it is a trigger? Why am I saying this is a trigger? So it is important for you to understand, how did we find ourselves saying this is a trigger? This is the trigger because we were told that the forecast AFS and the management accounts exclude the impact of the acquisition. So as an accountant or as a CA, as you grow, you understand that the reason that you are appointed in any organization or firm is to account for things that are not accounted for, or assist in accounting for things that they're not sure how to account for it. So in this case, we are told that this forecast AFS and management accounts exclude the impacts of the acquisition. So this acquisition has not been taken into account, therefore you needed to assist for that acquisition. Leopoldus is acquiring a controlling interest, potential a business combination. So why are we saying this is a controlling interest? Because we are told it's 55% acquisition. So that then triggers IFRS 3, which is a business combination. That is why the candidate that wrote this paper should have never went and wrote without understanding IFRS 3, because this is a business combination, and obviously the controlling interest is purchased, which is 55%. This requires your judgment and significant adjustment to IFRS FY24 reporting. So you need a very good judgment in terms of knowing which expense to account for or to capitalize, and which expense to, which cost to expense and which cost to capitalize. So that requires complex and as well as the judgment of significant adjustment in the financial statements. So most family trusts also affected possible consolidation or equity accounting. So again, this is important to understand the IFRS 10, because this is a possible consolidation. So the candidate should have made sure that they understand the consolidation, how to consolidate the 55% interest in the company. Right. So the key accounting issues to consider. So what were the key accounting standard or issues to consider? Control assessment, IFRS 10. So now you ask yourself, is there control, yes or no? Based on the 55% holding, I can strongly say there is a control. However, there are other things that we need to take into account when it comes to control, which might not only be the 55% holding or the majority holding. It could be other things when it comes to control and management of Cafe Rapid. So it is important for you to ask yourself, is IFRS 10 applicable or not? But in this case, you cannot go to the exam without understanding IFRS 10. Does Leopoldus obtain a variable return and ability to influence the return? So that's what IFRS is saying when it comes to control? Do you have the power to variable returns, and do you have ability to influence those returns? So it basically means you can control the profit, and then you have the power over it, right? So that is the most important thing to decide whether Leopards have control or no control on the cafe repeat. Consider voting rights, contractual arrangements, and the trustees' involvement. So it is very important, in order to assess the control, to look at the contracts, whether the contractual agreement between Cafe Rapid as well as Leopards. So you need to understand that, because that will show you whether they control or not. Then we're looking at point number 2 that I've looked at is Cafe Rapid a business? So if it's a business, then IFRS 3 is applicable. That means you need to understand IFRS 3 business combination. Assess whether it includes input, process, and ability to generate output. If not a business, treat an asset acquisition. So in this case, we can conclude that Cafe Rapid, it's a business. It is a business because they have input, they have processes in place, and they have ability to generate output using those input and processes. So therefore, this is a business combination as opposed to asset acquisition. Number 3, the other important thing, it is an acquisition date. So you need to identify the acquisition date, when the control was obtained, critical for fair value measurements and the consolidation. And then we are told here the acquisition date is 31 October 2024. So now looking at the 3 points that we've looked at, it is IFRS 10. You needed to understand IFRS 10 before you go write the paper. And IFRS 10 covers the power over variable returns and ability to influence, as well as the contractual agreement. What is stated in the contract? Is it saying yes, the majority voting right is what gives control, or is saying otherwise? In most cases, if a company owns more than 50%, it is deemed to have obtained control if there are no other things in the contract that says otherwise. We're looking at number 2, and we said, yes, this is a business and they needed to consolidate. And then now we're looking at acquisition dates. We see the acquisition date have already been provided, 31 October 22. Now let's just look what comes next in the slide. In our next slide, we're looking at number 4. Number 4 talks about measurement consideration transferred. Cash or non-cash consideration, the contingent consideration, and the transaction cost expense. So now what is important when it comes to measurement? So at acquisition, you need to understand, how are you going to measure this cost? In this case, we are told that there will be an initial payment by 31 January 2025 of 26.345, and then there will be a contingent purchase consideration. So now we know that there will be a cash payment, and this cash payment is made up of the initial purchase price and a contingent consideration, which looks at the financials for 25, 26 to 27 EBITDA. So it is important to understand that, yes, you have contingent consideration, and also there's a cash payment that you need to pay upfront of 26.345 million. In terms of transaction cost expense, then the transaction cost expense will be things like your legal cost and any other costs that should not be capitalized, and that you need to study before you go to the exam. So before you candidate go to the exam and write this paper, they need to know which cost should be capitalized in the acquisition and which cost should be expensed. They need to know that and have a clear understanding of the expense that need to be capitalized and not capitalized. And the fair value of identifiable asset and liability. So you need to know what is the fair value of the asset that were acquired and liability assumed at acquisition date, which is 31 October 2024. This is when then IFRS 13, which is fair value measurement, becomes very important for you to understand. Then the intangible asset, the brand, customer list, and receipts. IFRS 9, financial instrument for shares. So I've spoke about the fact that you needed to understand the IFRS 9 when it comes to financial instrument, which is shares plus obviously contingent consideration, and then the IFRS 13 for the acquisition date measurements. Because you're going to be consolidating, you need to calculate the fair value of asset and liability. Then you need to apply IFRS 13 at the acquisition date measurements. And then there's deferred tax on the fair value adjustment. So deferred tax is always obviously important when it comes to your aid acquisition journal. So everything that has deferred tax, you need to know which will be those items that will have deferred tax and how to account for deferred tax in those items. It is very important that candidate, before they go and write, they had a clear understanding of all this thing that is listed on the slide. Then the next thing, obviously, once you've done everything that is done on the previous slide, then you need to ascertain whether there's a goodwill or gain on bargain purchase, right? So goodwill means we paid over what the price, and then bargain purchase we pay less. So that is based on consideration, the NCI, the fair value of net asset, and previously held interest, if any. Right. So you calculate the goodwill or gain on bargain purchase based on the what we paid, what is the NCI, what is the fair value of asset, obviously the previously held interest, if there is any previously held interest. So the candidate needed to understand how to calculate the goodwill and the gain on bargain purchase using this component that I have listed here. You should have never went and wrote the paper without knowing how to calculate goodwill or a gain on bargain purchase. Number 7, you need to determine what will be the amount of non-controlling interest, which is NCI, in this case, the 45%, which is what the shareholders will held, the current 3 shareholders will have ownership of. You need to measure at fair value proportionate share. So what is the 55% share and what is the 45% share of the NCI? Then what is the impact of goodwill and group entity? So it is important for your candidate to understand how we're going to calculate the goodwill or gain on bargain purchase, and also we need to understand how to calculate NCI. Right. So those were important things that candidates needed to equip themselves before go and write. So it was going to be a very big struggle for them to go and write without understanding the goodwill or how to calculate goodwill, or how to even see goodwill and bargain purchase, and also how to calculate or account for NCI. The impact on the Leopardus FY 2024 reporting. The effect on the income statement: consolidate Cafe Leopardus from acquisition date. Because now we obtain 55% interest, you need to understand that going forward, then from the acquisition date, we need to consolidate in the books or in the income statements the Cafe Repeat acquisition related expense in P&L, impact on the depreciation or amortization from fair value adjustments. Then that is what you need to look at when it comes to income statements and the balance sheet. You need to recognize acquired assets or liability at fair value. You recognize the goodwill. You recognize the NCI. And then when it comes to cash flow, acquisition cash flow should be included under investing activities. So those are kind of things that you should have known before you go and write this paper when it comes to the income statements, the balance sheet, as well as the cash flow statement. Then the impact on most family trusts depends on the structure. If the trust control Leopardus consolidates enlarged group. So now, because we know trust still hold 70%, then there will be effects on them, because that means they need to take into account when they're consolidating Leopardus, they need to also consolidate the new company that has been purchased by Leopardus, which in this case, it is Cafe Repeat. If trust holds a direct stake in Cafe Repeat, equity accounting or fair value adjustment. So you need to know the structure. So you need to really understand the new structure in order to decide which path they need to follow when it's come to Moore's Family Trust. Then looking at the disclosure requirements, IFRS 3, nature of the acquisition, the date, the percentage acquired, the consideration of fair value of assets and the liability, as well as the goodwill. The pro forma information is it acquired as a start of the year. Then let's come to International Accounting Standard 1 and IFRS 13, significant judgment and estimate. So it is very important to understand that because we are told that it is not accounted in the projected financial statements, when it comes to financial statements, we're not only looking at the amounts, so we're looking also at the disclosure requirements per International Accounting Standard 1 as well as IFRS 13 when it comes to significant judgment and estimate. We have estimate here because of the contingent consideration, which will require management judgment and estimate. And we need to consider that. We need to show that we understand those information, as it's very critical and important for you, candidate. Then This paper obviously required a lot of judgment when it comes to looking at the document. You need to determine the control. You need to ask yourself, is this business or it is an asset acquisition in order to identify whether we should apply IFRS 3 or not. You need to fair value measure the asset acquired and liability assumed. Obviously, in that case, you need to use the IFRS 13 principle, which is fair value measurement. You need to measure the NCI. We didn't acquire or we're not planning to acquire the entire 100%. There will be 45% that is left to the shareholders, the current shareholders. In that case, you need to understand how to measure that NCI. So how to measure the balance. The deferred tax implication at acquisition, when you are looking at the IFRS 3, you need to know which items triggers deferred tax, and you need to know how to account for deferred tax, whether using CGT or using 27%. It is very important that candidates had a clear understanding when it comes to that. So that takes us to the end of the paper in terms of how you needed to keep yourself. If you have any question when it comes to this document, please feel free to ask me and I will be able to respond to you. If there's a way that you feel like I can improve when it comes to this analysis, please let me know. I'll be able to take into account of your comment. And again, please follow me on this page and share this videos with people that you believe might be interested in this content and might benefit from it. As you are preparing yourself for your final exam, I wish you all the best and bye-bye.